All right. Now, Robert had sent me an email early this afternoon, shortly after the invitation for the webinar went out. And he says that he holds SPX call leaps, December 2025 expiration, 609 days away, which he's selling shorter term calls against for income, sort of doing calendar spreads, poor man's covered call. And he says they've taken a hit with the interest rate messaging from the Fed. He says bought it at an 82 delta. It dropped overnight to a 69 delta. He says, although I understood the general relationship between interest rates, ROE, and the impact on options evaluations, especially the longer term options, I would appreciate any thoughts or guidance you can provide to best manage this element of trading. We haven't really had to pay much attention to ROE for the past 5 or 10 years because of the zero interest position of the Fed, but that certainly changed. And as these increases in interest rates went up, the call premiums and call prices, premiums to sell for the longer term options should have gone up as well. But it says for many of us, the whole issue of factoring in the role of rising, falling rate and ROE is one we have to come face to face with real seriousness. If you could address the management of this previously disregarded Greek, it would be appreciated. Okay, now let's just go into some of the basics that we want to talk about here. ROE, in its simplest terms, is the change in the option price related to a 1% change in the interest rates or any change in the interest rate percentage. In the past, in 5, 10, 12 years, we haven't paid much attention to it, as Robert had mentioned. The LEAPS options and longer term options tend to be most affected by these changes in the interest rates. Now, an increase in the rates will typically increase the call valuations, and reverse will lower the valuation of put options. A decrease would have an opposite effect where we would expect a change in the call premiums without a movement in the underlying security, of course, or other aspects of other Greeks. And of course, the puts should increase in value with those prices. So when there's a higher interest rate, it's a better time to get into those married put positions against your stocks, because all things being considered, if the interest rates start to fall and the market comes back up, optimism is more renewed, the valuation of the puts should start to move up too, which might give an extra boost to those positions. We'll see that as it plays out over time, because Ernie and myself and other here at Power Options and Radioactive Trading will always have the married put positions open in our portfolio, shown in the Fusion account at Radioactive Trading. Now, based on Robert's Delta comment, it appears that we're looking at the 2025 December 5,000 strike. This is 609 days away. This is the option currently that has a delta of 0.69. It's now just out of the money, with SPX closing yesterday and today below 5,000. Now, the current price of this call is $608.05. Essentially, you're looking at it's about $1 a day, although that's not how it's going to decay, but it's about $1 a day for the now out of the money option for 609 days at a time. Now, let's use Power Options to estimate the change in price due to a change in ROE. There's a few simple tools you could do with that very easily, Robert. So let's go take a look at that right now. We're going to navigate over to the Power Options suite of tools. Okay, there we go. Just one second, folks. All right, and we see here that we are in a light buy as of yesterday's close on the market sentiment tool. But what I want to do here is we're going to go to the chain. And the simplest way to do that, of course, Robert, is if you can link to it directly from your portfolio position, if you're tracking this in your portfolio, or naturally, you can just type in the stock symbol, and all of the indexes here on Power Options require the $ to look for, $ SPX, $ NDX, RUT, and so forth. And then we'll just want to click on chain. And then, of course, when we do that, we'll navigate over to just looking at calls only for your expiration date. And as you see here, the SPX 5000 call, currently priced at 608.05. Was this when the market was closed? It was just after 4 o'clock, so it might have changed slightly. But this is the one that currently has the delta of 0.68. Now, whether you're tracking this position in your portfolio, whether you're identifying it in the option chain, what we want to do to analyze an expectation of change in your option price based on a change's interest rates, we'll just use that Edit More Information button. We're going to go to Calculators. And now we're going to go to Black-Scholes. Of course, the Black-Scholes calculator gives us the theoretical price on the option based on the 5 components of the Black-Scholes pricing model: the underlying stock price, the strike price of the option, days remaining to expiration, implied volatility or volatility on the underlying security. Typically for farther out, we want to use the implied volatility of the option, which is shown here, dividend factor, and of course, the current free market interest rate. When we saw the price listed at 608.05, the theoretical pricing model is close, as it at 607.81 for this now slightly out of the money call, with SPX trading just under 5,000. Now let's say that we do get a 0.5 reduction. I mean, that's probably not, so we're expecting 0.25 at one point, hopefully we were, and then another 0.25, something along those lines. But let's say we get a 0.5% decrease in the interest rate. Our current price, 608.05. The expected price, 607.81, pretty close. And if we drop this down to 4.66 from 5.16, today, that expected price would change down to 584.56. You'd lose almost 20 basis points expected from that 607.81 theoretical value to the 584, maybe a little bit more than 20 points, but that's the expectation you would see for a 0.25% decrease. Now, we're not expecting that tomorrow naturally, but as time goes on, you're fighting several different things on this option, right? You're fighting the change in SPX. SPX has been declining naturally because of the messaging about the Fed, global conflicts as well, other aspects in the U.S. economy. So we're pulling back from these highs that we saw of around 5,200. I mean, recent. I'm going to explain that in a moment. I was looking at this earlier, so what I mean by that is recently. But if you expect this to happen down in May, maybe down in June, you can just scroll down and see what the price effect would be, what the theoretical expected value of your option would be. Now, we hope that a cut in interest rates would also lead to some optimism in the market, so you might expect this to now go back in the money, and you could change the stock price to say it's up at 5,100, 5,200, something along those lines, and what would the value of your option be with the new interest rate? This will help you prepare and plan for what kind of hit you might take with the change in interest rates based on if you expect a 0.25 decrease, a quarter point decrease, I should say, or a full half point decrease, and when you expect it to happen. And also now, what would you expect that to do with the markets as far as the current price, underlying price of the index, and how would that affect your option on any day between now and expiration? But it is a noticeable change. So your question mainly was, how can we prepare for management on this? Well, if you're expecting a change to come up and you're expecting that's going to hinder the price of your option, you might want to look into buying a shorter term put, usually the opposite of what I'd say to do. You know, with the married put positions and why we want to buy further out in time, exactly what you're following here with this lead call on SPX. But if I'm expecting some kind of rate decrease, maybe let's say in July or maybe later, when I get closer to that, I might buy an August or a September put option. Because what did we say? Even though it affects the further out options more, if there is that decrease in the price because of the decrease in the interest rates, you should see the put options increase. However, if your expectation is that that's going to cause the market to move back up, that's not going to act as much protection for you. It's still going in the direction that you want for this particular option. Doing what you're doing now is sort of the best approach, continuing to sell near-term calls against it. I am not going to recommend or suggest any type of involved ratio setup, ratio structure, ratio call spread, or ratio put spread, shorter term or near term, to complicate the position to try to keep a row balanced position on your long call. Your long call is going to be successful if SPX continues to move up in the direction you expected while you're selling near-term calls against it, even though you should expect some price movement if there is a rate decrease, theoretically. But again, it could overcomplicate things drastically. You hear all the terms all the time, having a delta neutral position, which gives you safety from volatility, gives you safety from movement. It involves a lot of activity, and it involves constantly adjusting the position. And then you talk about gamma neutral. And then you talk about row neutral if you're expecting movements, and people do play that. but you're going to have multiple legs open and multiple moving pieces that you're going to keep adjusting shortly after the rate changes happen, one direction or the other. I don't know if it's worth that complication if your long-term goal is still, I expect SPX to be moving up, and to when and to where anytime over the next 609 days. I do want you to use this tool because I do want you to be aware of what changes this might affect based on what rate changes you are or not expecting. Interest rates haven't changed yet. The talk of them has happened. The talk of interest rate changes not happening is what's caused the market to decline. This is why your delta dropped from the 0.85 you mentioned down to 0.69. And we can see that. Let's go back to the option chain. And we're going to go to research. We're just going to go to call research. And what I want to do here is just take a shorter time frame. And we're going to use, I changed the views here. Instead of the default is usually implied volatility versus the option last price, I changed this view of the historical data to be delta versus stock price. So sometime over here is when your delta was up to 0.85. When SPX was at 52.48. In just that short 8 or 9 day period, because the fear that there won't be any rate cuts because of the hot inflation numbers that came in, other consumer reports that came in, well, now we're down to below 5,000. We're at 49.11 to declare. Let's refresh this real quick. Yeah, 49.67. So now your option is out of the money. And this is why the delta has fallen drastically over the last couple of days, even the last day or two that you saw. From a delta of 0.76, we're down to about 0.69 here and there. Okay? So that's what you've been encountering more because of what they messaged about not changing the interest rates. Rho will have an effect. You can use the Black-Scholes calculator, as we saw, linking to it from the option chain or from other tools to see what effect the change in interest rates would have based on when you expect that might happen or might not happen. If the interest rate changes don't come as you're expecting, all things being considered, we should see about the same thing. You're fighting time decay is one thing, of course, as we get closer and closer to expiration. Yes, we're 609 days away, but you're going to see time decay on your option, whether it's at that 608 price that we saw, 608.05, or slightly in that ballpark. You're fighting the movement of SPX. You were in the money, and now you've gone to an out of the money option. So now this is all intrinsic value. The 608.05 I'm sorry, it's all extrinsic value. Wow, Freudian slip there. It's all extrinsic value. So naturally, of course, if SPX does start to rally in the next week or two, shrug some of these things off, shrug some of the global things that are going on. We never know what's going to happen over the weekend. If we go back up to maybe 5,050 or 5,100, you'll probably see this go back up to $700, $720, and your delta will go back up to 0.75, 0.77, 0.78. But without the change in the interest rate, which I mentioned I want you to look for, I want you to plan for, but if you're not expecting it to happen, what you need here is the stock to do, the underlying, I should say, to do what you want it to do for a bullish position of a straight long call. All right, that's what I'm looking for in those situations. That's what I just wanted to answer for Robert. I don't want to get too complicated into these other concepts of row hedging, row neutral, planning on the rate hike. When is it going to be? When is it not going to be? What structure do I want to use to hedge this position? Keep doing what you're doing now. If you're expecting a drastic change in the price due to a rate change movement sometime in the future, plan ahead for that based on what you want to try to lock in with any gains you have on the call option, which you maybe don't now with the last movements of the market over the last week or so, 2 weeks, really 10 days. And again, there are hedges that might be able to be used, but they're going to be complex. And just like any kind of quote unquote delta neutral, gamma neutral, or hedge position, it's going to involve multiple legs and it's going to need to be adjusted continuously. And you're really looking for adjust it or to hedge it just on that one short-term movement as well.